IAS2 again. First we'll solve this important question. In a manufacturing process of Vijay Limited, one byproduct BP emerges besides two main products MP1 and MP2 apart from scrap. Details of cost of production process is here under. Now this is a problem of joint product. Okay, which are the two main products MP1 and MP2, and there is a byproduct also, and there is some scrap also. So four items are emerging out of this process. MP1 main product 1, main product 2, byproduct, and some scrap. Now see the details. Raw material units 15,000. These are the cost incurred on raw material, wages, fixed overhead, variable overhead. These are the output produced MP1, MP2, byproduct. And this is the closing stock of MP1 and this is the closing stock of MP2. Average market price of 1 and 2 is rupees 80 and 50 per unit respectively. So this will help us to calculate the relative sales value. Byproduct is sold at rupees 25 per unit. Byproduct 1600 unit into 25. How much? Whatever. Calculate 1600 into 25. 1600 into 25. 40,000. There is a profit of 5,000 on the sale of the byproduct after incurring separate processing charges of rupees 4,000 and packaging charges of rupees 6,000. Rupees 6,000 was realized from the sale of the scrap. Calculate the value of closing stock of MP1 and MP2 on 31st March 2012. They have not given you one information, that is NRV of these two products, MP1 and MP2. So in that case you will assume NRP is higher than the cost and therefore they will be valued at cost only. Is it right? Now in such problem we need to first find out how much is the joint cost to be allocated over MP1 and MP2. Is it right? What is the total cost? Can you just take the total of this? If you see total cost of these four items, 3,40,000. Now from this I will deduct the NRV of byproduct. NRV of byproduct would be, as you correctly said, 25 rupees into 1600, 40,000. But in order to complete the sale, you need to incur a separate processing charge of 4,000 and need to incur a separate packing charge of 6,000. 40 minus 4 minus 6. How much? What about the profit? This profit of 5,000 is sale on the byproduct. That you don't need to adjust. That you don't need to. You have to just adjust the NRV part. And then you also deduct the scrap value. Scrap value. How much is the amount you will realize on scrap value? 6,000. So joint cost applicable to main products will be 3,04,000. Okay. So to confuse you, they have given this byproduct profit which is not to be included here. Now once you get this figure, this means this is the cost that is attributable to MP1 and MP2. From the total cost, whatever we could recover by selling the byproduct and scrap, that we have reduced, which means now the remaining cost is attributable to the other two products. And then as usual, you will first find out what is the relative sales value. So take your calculator, multiply 6250 into 80. So the sale value of MP1 is 5 lakhs, 6250 into 80, and sale value of this will be 5000 into 50. How much? 2,50,000. Therefore joint cost of rupees 3,04,000 allocated or apportioned in the ratio 2:1. 2:1. So 3,04,000 into 2 by 3. 2,02,000, 667, 1,01,000, 333. Number of units. Number of units are 6250 and 5000. So cost per unit. Can we get cost per unit now? This divided by this comes to 32.43, and this is 20.27. Closing stock quantity is 200. Therefore value 25944 and 4054. Total of both is 29998. So this will be the answer. But with a note, it is assumed that NRV is above the cost. NRV is above the cost. So this was an important question. They can ask you smaller question also. Next is, what about the other cost? Will other cost also be included in the cost of inventory? Will other cost be also included in the cost of inventory? It depends on if costs are incurred to bring the inventory to present location and condition. If costs are incurred to bring the inventory to their present location and condition, like for example design cost, designing a component, okay, or machine hire charges, special, say, packaging for preserving the product, or for example special storage for wine, etc. Right? So that can also be included. Example I have written there, cost of designing product for specific customer. What should be excluded from the cost? Cost of the inventory should not become abnormally high. Is it right? So therefore, we have to try to reach the normal cost of inventory. So abnormal items of wasted material, abnormal labor, and abnormal other production costs will not be included in the inventory cost. Storage cost, unless they are necessary in the production process before a further production stage. So in some cases, like say wines, storage is a part of the production process. They are kept in special storage. Then it will be included in the cost of inventory. What about point C, administration overhead? Administration overhead that do not contribute to bringing the inventory to their present location and condition will not be included. And what about the selling and distribution cost? Not to be included at all. Point number A in your note and point number D in your note never to be included. Abnormal cost and selling cost. What about borrowing cost? Borrowing cost which are qualifying under IAS 23, okay, will be considered in the cost of inventory. Other borrowing costs will be charged to profit and loss statement. Okay, so in your note I have written properly, borrowing cost will not be included. It will be included only if it is related to a qualifying asset under IAS 23. What is IAS 23? Borrowing cost. Now come to next paragraph, deferred settlement purchases. Deferred settlement purchases. This is trying to bring the concept of substance over form. First understand, then we'll read the paragraph. Suppose A Limited purchase goods from B Limited today, and let us assume it will make the payment after say 3 years. It will pay 50 million. It will pay 50 million. Understood? But when? After 3 years. What is the amount at which the inventory will be recognized today? 50 million or less than 50 million? Less than 50 million, because see, common sense, if you buy something today and if you buy and pay after 3 years, will the supplier charge you the same rate, or will he include his finance cost or interest component in the selling price? He will include. So therefore it means this 50 million includes interest of 3 years which the supplier is including. So you will have to compute the present value of 50 million, and that is the amount at which inventory will be initially recognized, and thereafter you have to unwind the interest. It is like you have taken a loan from the supplier, so every year that interest portion will get included in the supplier's carrying amount. So calculate 50 divided by, suppose your interest rate is 10%, 50 divided by 1.10 to the power 3. How much is that? So around 37.5 million. This is the value at which the inventory will be recognized. And then in the first year you will calculate interest on this amount. 10% of this amount. How much? So first year you will pass an entry, finance cost account debit 3.75 to supplier of material 3.75. Supplier of material value will increase by 3.75. Again next year 37.5 plus 3.75, and 10% of that will be the finance cost of the second year, and this way third year, and then you will make the payment of 50 million supplier account debit to bank. Is it right? So now what we'll do, we'll solve one example on this in the notebook. The company found that its inventory of raw material include an item amounting to rupees 50 lakhs or 5 million purchased on deferred payment basis. Purchase on deferred payment basis means it might be including some interest component also. As per the terms of the purchase contract, the company shall make 10% down payment. So out of 50 lakh, 10% of 50 lakh, 5 lakh rupees will be paid now. How much is remaining? 45 lakh. Balance into equal installment. 45 divided by 2, 22 lakh 50,000. So that will be paid in 2 annual installment. Date of purchase of the item of inventory is 1/1/2019. Incremental borrowing rate is 10%. So what you will have to do, you have to find out what is the amount at which the inventory purchase will be initially recognized, and then you have to pass the entries also till the payment date. Okay. So question, write down pass journal entries from date of purchase till the date of payment. Pass journal entry from the date of purchase till the date of payment. Substance over form. Even though in form it appears the value of the inventory is 50 lakh, but actually it is not 50 lakh. It includes some interest element also. Interest element will not be included in the cost of inventory. Borrowing cost will not be included in the cost of inventory unless the inventory is a qualifying asset as per IAS 23. So we are assuming it is not a qualifying asset as per IAS 23. So tell me first, what is the amount at which the inventory will initially be recognized? Okay. So write down the heading. In your notebook, write down inventory are measured at discounted cash flow as follows. Inventory will be measured at discounted cash flow as follows. So I have drawn a small table for better understanding. Year, amount, discounting factor at 10%, present value. Year, amount, discounting factor at 10%, present value. So there is a note which says that 10% amount will be paid as down payment. Means today we'll pay at 0 in year 0, 10% of 50 lakh. 10% of 50 lakh, 5 lakh. Factor is 1. Present value 5 lakh. Just check the calculation. In 1 and 2, you can write 1-2 also. Do you want to write 1-2? You can do that. 22 lakh 50,000. Factor, write down, multiply. This installment which you are going to pay in first year has a present value of check 2045475. Yes, okay. 22 lakh 50,000. You can do it separately. You can combine them together. Is it 18 lakh 59,400? Tell me the total. Is the total right? 44 lakh 4,875. Okay. Can you write journal entries now? So I will help you. Journal entries, write down. First write down year 0. Purchases account debit 44 lakh 4,875. Correct? Yes or no? To creditors 44 lakh 4,875. Whatever total you have got it here, you write it. In year 0, we will pass one more entry. Creditors account debit. Creditor account debit 5 lakh to bank account 5 lakh. To bank account 5 lakh. Creditor account debit 5 lakh to bank account 5 lakh. Okay. After, keep calculator ready. After passing this entry, your creditor balance will be 4,404,875 minus 5 lakh. 39 lakh 4,875. On that amount you will compute interest. Is it right? For 1 year 10% into 10%. So now you write down year 1. Year 1 finance cost debit 390,488, correct? Is it 390,488? To creditors account 390,488. It is like passing entry for your installment system accounting, learnt long back. Year 1 end you pay creditors. Creditors account debit 22,50,000 to bank account 22,50,000. First installment paid. First installment paid. And what will you do with this finance cost? P&L account debit 390,488 to finance cost 390,488 to finance cost 390,488. Close the first year. Now what I need to do? I need to find out what is the balance left in creditor account first. So your opening balance was something like 39 lakh 4,800 something, right? To that you first add 390,488 and then minus 22 lakh 50,000. So what is the balance left right now? 20 lakh 4,536 or something. Is it right? Say yes. Yes. Now I need to pay 22 lakh 40,000. I need to pay 22 lakh 40,000. What is the difference between this figure which is appearing on calculator and 22 lakh 50,000? Around 2 lakh 4,637. Yes or no? So in the second year, I should write the interest in such a manner that the balance should become, after paying the second installment, the balance should become 0. So can you tell me how much interest you will provide in the second year so that your creditor balance should become 0? Is it 2,04,637 plus minus 1 rupees? You have to find out first opening balance of creditor. Take 10% of that. But at the same time, what I need to do in the last year, I need to close my creditor account. So the interest will be the balancing figure. Creditor to bank 22 lakh 50,000. P&L account debit to finance cost. Year 2. Okay, just let me see whether you have done it correctly or not. Your creditor balance should become 0. What was the first figure you have taken? 44,04875 minus 5 lakh plus the interest of the first year was how much? Add that interest of the first year 390,49. फिर minus 22 lakh 50,000 plus interest of second year 2 lakh 4,637 minus 22 lakh 50,000. Is it 0? 0. If it is not 0, then maybe 1 rupees you can adjust in the finance cost of the last year. Understood? So this is a problem on deferred settlement purchases. So they can give you question in any way, you can solve it like this. First find out the present value of the cash flows like this, and then you do the accounting in this format. Okay. Write a note, it is assumed that the inventory is not a qualifying asset. It is assumed that the inventory is not a qualifying asset. Inventories are not qualifying assets. Hence, finance cost is charged to profit and loss account. Hence, finance cost is charged to profit and loss account. Okay, assuming you have done. Come to next discussion. Next discussion is cost of agricultural produce harvested from biological asset. Once the agricultural produce is harvested, means removed from the biological asset. For example, a mango growing on a tree, you'll apply IAS 41. But once the mango is removed, now it becomes an inventory. Then IAS 2 will become applicable. And what is the valuation principle for such agricultural produce which has been harvested from biological asset like fruits, vegetables, milk? Okay, the principle is in this case fair value less cost to sell at the point of harvest. Fair value less cost to sell. When you will go to IAS 41 also, after some time you will find it is mentioned there. Once it is harvested, IAS 2 becomes applicable, and the valuation principle is little different here. It is not cost or NRV, whichever is lower. Very difficult to calculate the cost. Okay, so therefore the rule is fair value less cost to sell at the point of harvest. This is the cost of inventory at that date for the application of this standard. So on that day the inventory will be valued at this rate, and thereafter IAS 2 will take the charge. So every reporting date you have to then calculate the fair value less cost to sell, and then it will be valued. Okay. Now our next task is inventory valuation techniques. So which are the inventory valuation techniques? First, understand this diagram is there in your note also somewhere below, so no need to draw right now. Inventories for valuation purpose we can divide into two categories: those which are not ordinarily interchangeable and those which are ordinarily interchangeable. What is the meaning of not ordinarily interchangeable? They are specifically made, manufactured, okay, designed, produced for a specific customer. Only he will use it. Okay, it is designed for that customer only. For example, designer car. Cars which are designed specifically for a customer, or designer bikes. Okay, designer clothes, designer jewelry. Okay, so that is only meant for certain customer only. So therefore what you will have to do in such cases, you have to use a method called specific identification method. Example also I have written there. Generally used in jewelry and tailor-made industry. Okay, or your furniture which is designed for a customer. What this industry does, or they should do, they should make a keep a record of what cost has been incurred on which particular item. So they will assign a job cost number, worksheet number, something like this. Is it right? And they will instruct their office staff that whenever you incur cost on this particular job, you charge it to this job only. Is it right? So their software computers are also accordingly designed so that they will be able to capture the cost of that particular item. But if the inventories are interchangeable, then again we have two methods: historical cost method, non-historical cost method. Historical cost method means it is based on actual cost that we have incurred. There is an invoice on which the cost is mentioned. There are two approaches allowed here, only two, FIFO and weighted average. So remember, LIFO is not allowed. LIFO is not allowed. If you have studied LIFO in your any other subject, it is good for that subject, not here. And there are two non-historical cost method. Means here we don't use the actual cost incurred, but we make some adjustments to arrive at approximate correct value. Okay. And these two methods are called standard cost method and retail inventory or adjusted selling price method. Popularly retail price method. What we will do, we'll see one by one now. Retail method. Standard cost method I can explain easily. Here the value of the inventory is based on predetermined cost, that is standard cost. And the standards are reviewed, revised periodically. There should not be too much variation between the standard and the actual. But I have seen practically for financial reporting purpose, there are almost negligible number of companies which follow standard costing method. They can use it for their own internal costing purpose or management control purpose, but for financial reporting purpose, you will hardly come across industries or companies which follow standard cost method, but it is there in your syllabus. What is a retail price method? It is allowed for the retailers, that is those who have continuous activity of buying and selling. Large number of customers are flowing in to the retailer shop and they may find it very difficult to keep a record. Okay, they may find it very difficult to keep a record for each and every transaction. And so what the standard says, it says we will allow you one more method if you find it very difficult to do record keeping for each and every transaction. You take the sale price of that item, you deduct the profit margin. So the difference is your cost. Is it right? Cost is selling price minus profit. So you are a retailer. On every product the selling price is mentioned. There is an MRP printed. And you know how much profit margin you have for each product. Remove it. You get the cost. If you are selling multiple products, say you are selling A, B, C, D, 4 types of product with 4 different margins. So on this you make a margin of 40, 30, 20, 10. So accordingly you calculate their valuation. So at the end of the year, make a list of all the items that you have. Write their sale value. Remove the profit margin. Difference is your cost. That is called retail price method. Have you ever come across a company doing this kind of exercise? Student is saying no, because nowadays there are computers. The standard was designed long back. Standard was written long back when computers was not so common. Okay, information technology was not that common, but nowadays you have software. Why you need to do this exercise? The moment you buy goods, you scan it in that barcode reader, your inventory records are also simultaneously getting updated. So therefore, if you can, see the standard also says, if you can apply the other methods, historical cost method, then you can't apply non-historical cost method. This is only for convenience. This is only for convenience. This is not something which you can choose. If you can apply FIFO method or weighted average method, then don't apply this method. It's only for convenience. Anyway, so we'll not spend too much time on this retail method and standard cost method, because practically they are not very relevant now. Solve this one small question. Selling price of an item of retail department is 1000 rupees. The retail department uses a gross margin of 25%. What should be the valuation of that item? 1000 rupees selling price, 25% is gross profit ratio on sale. Answer 700, 750, 800. One student is saying 800. One is saying 750. The answer is 750. GP ratio is applied on sales. GP ratio is applied on sales. So the answer write down there in your handwriting. Thousand minus 25% of 1000. That is rupees 750. Okay. Noted? Okay. Now, the standard also gives you some instruction. An entity normally is required to adopt the same cost formula for all inventories having similar nature and use to the entity. So, inventories which are similar in nature, similar in use, similar in nature, similar in use, are required to follow the same cost formula. Okay. However, the use of different formula for inventories with different nature of use has to be justified. But if the nature of use may be different, then maybe you can use a different method. So same item, for example, of a raw material, which you can use for your production also. And you also sell it also. You trade also in that item and you use it for further processing also. So the nature of the use is varying here. You are using it for trading purpose also and you are using it in the production process also, same item of raw material. So in that case you can apply two different methods. But suppose your inventory, same inventory, is located in A and B, two warehouses. Can you follow two different methods? Just because their locations are different, you will not follow two different methods in that case, because nature of the use, nature and use are similar in this case. So that question they have asked. Okay. Now NRV. Do you want me to explain FIFO method and weighted average method? Or you will do yourself? FIFO, first in, first out. Weighted average is the average of inventory. Weighted average can be on two bases, periodic and perpetual. Periodic means you compute the average once in a period. That period you can define monthly, quarterly, half yearly or yearly. Perpetual basis means after every time a new inventory is purchased, you recalculate the rate and you apply that rate for all subsequent issues. So whatever you have learnt in your 11th, 12th account or your other courses, same is applicable here. Now we'll come to net realizable value. This standard uses the term net realizable value. Most of the other standard uses the term fair value. One person has asked me this question also. Why this standard uses NRV and other standards uses fair value? One reason could be this is a very old standard, okay? Because earlier fair value concept was not very much in vogue. Only recently now most of the standards have started moving towards fair valuation, okay? Secondly, my objective is not to make profit before the goods are actually sold. NRV constitute the estimated selling price less the cost of completion and less the cost necessary to make the sale. Already discussed one example also we have taken. So you do the reverse working, take the selling price minus how much cost I am going to incur from this point till completion of the sale. Remove that. So you may incur some processing cost, some packaging cost, some delivery cost, some transportation, loading, unloading, handling. What you will get once this item is sold by you in your pocket, that means you remove other expenses. So what is the current status of the inventory? You see, this is the normal selling price. In order to reach this normal selling price, whatever cost you are going to incur, you have to remove it, and that will give you the NRV. Is it right? Remove any cost that you will incur to complete the sale. Who will estimate the NRV? Management. How will they estimate the NRV? On the basis of the most reliable evidence on the balance sheet date. Okay, after taking into account price fluctuation or cost directly related to events after the end of the period, to the extent they conform to conditions existing at the end of the period. Now suppose a company has inventory of 10 diesel cars. Company's inventory of 10 diesel car, cost is 4 lakh rupees. That means the value of their inventory is 40 lakh at cost. Okay. Year ending date is say 31st December. Now government is considering since last many months to ban these diesel cars. They are causing pollution. Okay. After the year ending date on 5th of January, law has been passed, and now the company are not allowed to manufacture new diesel cars now. So this company would try to remove it from the stock as early as possible, and immediately the market value of these diesel cars have gone down to 3,50,000 because people will not be interested in buying this. So NRV will be now based on the event after the balance sheet date, which only confirms the condition which existed at the balance sheet date. So NRV is 35 lakh. So in this case, the NRV was based on market situation which existed after the reporting date. Okay. So that can also be taken into consideration. Or simple example would be, you are manufacturing say laptops or mobiles, electronic equipment. Due to change in technology, you find that balance after the reporting date, the market value of those instruments have gone down. That can be taken into consideration while estimating the NRV on the reporting date. Practically, how do we do it? We will see what is our price list, because if we are dealer or if you are selling that item, can we not check our own price list? Can I not see the invoices that were raised on the last day? Can I not see the invoice that was raised on the last few days, if or not exactly on the last day? Or sometimes we also check the invoice of the next day after the reporting date to get an idea about the NRV. Okay. NRV is to be based on normal price. In this standard, why we are calculating NRV? Because the measurement principle of inventory is cost or NRV, whichever is lower. So that in case if the value of the inventory has gone down, the asset will not appear above their NRV. And if the NRV is high, we will record it at cost. We will not realize the profit. We will not record the profit unless the inventories are sold. Okay. Now, how do we do the comparison? Comparison should be done on item by item basis. However, similar items can be grouped. Similar items are allowed to be grouped, and then on the basis of grouping you can do the comparison. But which is the most ideal situation? Item by item, so that the loss in one is not compensated by the gain in another. If I compare the total of cost and total of NRV, loss in some cases Like for example, in second case, there is a loss will be compensated by a gain in first item. So we will not get the maximum loss. Concept of conservatism is getting applied here. So solve this example and tell me at what amount the inventory would appear in the balance sheet. At what amount the inventory will appear in statement of financial position. So we'll take lower of the two. First one, which is the lower value? Come on, fast. 22,000. Second, 42. Third, 12. 4, 28,000. Fifth, 26,000. And the last one, total. Don't take lower of these two. Take total separately. 1,30,000. So this is the lowest possible answer. However, grouping can be done on the basis of similarity. So tell me now, you are a learned professionals, how will you value raw material? Will you apply same logic for raw material? Depends on FG. Depends on whether the raw material is going to be used in the production of finished goods or whether the raw material is going to be sold as it is. Is it right? So first let us discuss if the raw material is meant for sale as it is. As I said, you can purchase raw material and you can use it whatever you want, and whatever excess quantity you have, you can sell it to others. So that portion of raw material which will be sold in the market, same formula, cost or NRV, whichever is lower. But then the standard says if the raw material or WIP is used in the production of finished goods. So what I am going to sell now? Finished goods. What I am not selling here? The raw material. So we have to see whether when we sell the finished goods, are we able to recover the cost of that finished goods or not? Whether finished goods will be sold at cost, above cost or below cost. Okay. So there are three possibilities. Finished goods may be sold at cost or above cost. Which in simple words, finished goods will be sold at a profit and not at a loss. Then in that case, there is no need to, reduce the value of raw material. Unnecessary. Why you want to reduce? You are going to recover the entire cost of raw material when you are going to sell the finished product. Your cost is recovered. There is no need to write down below cost if the finished goods are expected to be sold at or above cost. So here we are deviating from the usual measurement principle. Usual measurement principle is cost or NRV, whichever is lower. But for raw material which is used in manufacture of finished goods, and if finished goods are sold at or above cost, we will value raw material at cost only. But if the finished goods will be sold below cost, which means we are not able to recover the cost of the raw material, then in that case we will reduce if required, the value of the raw material. In case of raw material, instead of using the term realizable value, we will use the word replacement cost. Why? Raw material is not sold usually. Raw material is bought. So therefore, in case of raw material, the replacement cost will be the best available measure of NRV. Now we are going to discuss in the form of this flow chart, which I have drawn in your book. Question number 10, first you note homework. Question 10 homework. Now, stock of raw material. On the right side, if it is meant for selling for whatever reason, maybe one is due to overbuying. Second, you do both the activity, you produce also and you do the trading also. Is it right? So in that case, that portion which is meant to be sold will be valued at usual principle, cost or NRV, whichever is lower. But if it is held for production, and finished goods will be sold at or above cost, then raw material will be valued at cost. But if finished goods will be sold at a loss, then the rule will be cost or NRV, whichever is lower. But again here there is a limit on up to what extent you can reduce. There is a limit on up to what extent you can reduce the value of raw material. So kindly pay attention. Example is printed with solution. Only pay attention on the screen. A raw material costing rupees 150 has net replacement value of 130. The finished goods for which this raw material has other cost to incur is rupees 60. So what is my total cost of finished goods? 210. Total cost of finished goods 150 is only raw material and 60 is other cost. So say 210. And the net replacement value of raw material is 130. At what price raw material should be valued if the finished goods has an NRV of 210 or above, less than 190 or 200? So we'll discuss one by one. My total cost of finished goods as we discussed is 210. Situation number A is finished goods will be sold at 210 or above, which means am I recovering my entire cost of raw material? So even though in this scenario number A the replacement cost is lower, still we are going to value the inventory at cost, which means my first answer will be 150 rupees. And you will write, there is no need to write down the inventory raw material value. Okay. Now we are here, less than 190. Finished goods will be sold below rupees 190. So how much is the loss on finished goods? 210 minus 190. 20 or more. 20 or more. And what is the loss in the value of raw material? Again 20 rupees. So if the loss on finished goods is 20 or more, then how much we are going to value raw material at? Then in that case the raw material will be valued at 130. As the NRV of finished goods is less than its cost, the raw material will be valued at 130. But the trickier situation is this one, 200. Finished goods total cost is 210 and finished goods can be sold at 200 rupees. So what is the value of raw material in this case? How much is the loss in case of finished goods? 10 rupees. So what we will do, we will assume out of 200, 60 of this other cost will be recovered and 140 of raw material would be recovered. 140 of raw material will be recovered by selling the finished goods. Is it right? So in that case the value of the raw material would be 140 rupees, not 130. Is it right? Okay, now I am going to ask you one more question other than these three. Suppose this was 195. Instead of 200 it was 195. My question is, if the finished goods can be sold at 195, what will be the value of raw material? 135? 135. How much is the loss here? 210 minus 195, 15 rupees. Since the loss is less than 20 rupees, I am going to reduce only 15 rupees from the value of the raw material. Okay, one more. Suppose it is 175. If the finished goods can be sold at 175, what will be the value of raw material in this case? Now in this case the answer will be 130, because in any case my answer cannot go below 130. In any case my answer should not go down below 130. So in case if the loss in this example on sale of finished goods is between 0 to 20 rupees, then I am going to reduce the loss of finished goods from the value of raw material. But if the loss is more than 20 rupees in this example, then I am going to reduce only 20 rupees from the raw material cost. Okay. So this is about raw material and WIP. So there are exceptions in this chapter to the general rule that everything is valued at cost or NRV, whichever is lower is not always right. Raw material WIP which are used in production of finished goods are valued at cost if the finished goods will be sold at or above cost. Okay, now the next is one example number 12 homework. Example number 12 homework. Inventory held to satisfy firm sale or service contract. There is a paragraph on this also in the standard. Okay. This is your inventory. 5,000 quantity. Total quantity is 5,000. And what you are going to do with this 5,000 units? You are going to sell these units under a firm sales contract. Firm sales contract means you have entered into a contract with a party that I am going to supply 2,500 units to you. Okay. Or let me make it 3,000 so it will match with your question printed also. So 3,000 will be sold under firm sale contract. And what you are going to do this you are going to sell in the open market. So the standard says, now this inventory is meant for satisfying a firm sale contract. This inventory is meant to satisfy a firm sales contract. You have entered into a contract. Let us say you have entered into a contract to deliver this at rupees 45. And right now in the market, the rate is 49. And the cost of manufacturing of this item to is 50 rupees. So at what amount the inventory should be valued? So now this portion of the inventory, which is going to be sold under a firm sale contract, you will apply the principal here 50 rupees or the selling price under firm sale contract, whichever is lower. So that is the meaning of this line. Estimate of NRV also takes into consideration the purpose for which the inventory is held. The purpose for which the inventory is held. If this inventory is specifically meant to be sold to another party at rupees 45, then I will value it at that rate, and this is 49. So what I'll do, for this 3,000 I will apply the rule 50 or 45, whichever is lower, and for this I'll apply the rule 50 or 49, whichever is lower. Is it right? So what is the value of this inventory? 3,000 into 45 I will take, and 2,000 into 49 I will take. So see the answer. Is it printed in your book also? 2,33,000. Now in the above example, if the general selling price is 50, then how the valuation will be done now? So 3,000 will be valued at 45. And what about the other 2,000? The other 2,000 will be valued at 50, cost or NRV. For the general item, it is 52. So therefore 50. So the answer will be 2,35,000. One more question. Suppose in the above example, if the firm sale contract is to supply 8,000 units at rupees 45, we have only 5,000 unit, but we have entered into a contract to supply 8,000 unit. Means I am going to incur a further loss on 3,000 unit in future. then how the valuation will be done. So in this case, the entire 5,000 unit will be valued at 45, and then IND AS or IAS 37 will also apply here. What is IAS 37? Provision, contingent liabilities and contingent asset. So there is a concept of onerous contract which have become burdensome, where the economic benefit is less than the cost. So in the next 3,000 unit, my cost to manufacture is 50 and I am going to recover only 45. So IAS 37 will apply and you have to make a provision for loss of rupees 15,000. Okay. IAS 37 is mentioned there. Okay, try one more question. A dealer of sanitary fittings holds 100 pieces of wash basins for delivering to a customer under firm contract. The contract quantity is 900 pieces at rupees 3400. Same example, whereas retail price of the same is 4,200. What would be the NRV of the inventory? Only NRV they have asked. So what you do, this 1000 quantity you divide into two parts. 900 under the firm contract and 100 to be sold in general retail price. This will be valued at 3400. This will be valued at. Therefore, the NRV will be total of these two. Do this calculation. Is it coming to 34,80,000? Yes. This we will be able to solve. This can come as a multiple choice question also. Okay. Now we are almost towards the end of this wonderful chapter. Recognition in income statement. What will you do with the inventory in the income statement? Now, when we sell the inventory, the carrying amount of the inventory sold shall be recognized as expense in the period when the related revenue is recognized. Matching concept. If you are recording sale, you must also record cost of goods sold, consumption, and therefore the inventory to that extent get recognized as expense. Second time is when we reduce the carrying amount of inventory to NRV, the write down and other losses will be recognized in income statement. It will form part of profit or loss, section 1. Okay, not in other comprehensive income. Are we allowed to reverse the write down of the inventory? Yes, you can, because the rule is cost or NRV, whichever is lower. So next year if the market price goes up, you can increase the carrying amount of that inventory. Where will that gain be recognized? Again, in the statement of profit and loss, part 1, the amount of inventory recognized as expense shall be reduced in the period in which the reversal arises. So automatically, if you increase the closing stock figure, your expense charge will get reduced to that extent. So this is about recognition in income statement. Can the inventory be capitalized to other asset? Can the inventory be allocated to other asset account? The answer is yes. For example, inventory used as a component of self-constructed property, plant or equipment. You are constructing a, say, building, okay, and you have inventory of cement. Cement inventory that you are using in construction of your own office building. What about the cost of that cement consumed in construction of own building? It will be added to cost of building. It will not be treated as expense in that case. Is it right? Or for example, you have some intangible asset. There also you can add it if it is required. Inventory allocated to another. How we can? Oh, that's a wonderful question. You may be doing some experiment, so for that you might require some inventory which is used for developing, producing, doing some research, okay, and which is eligible for capitalization. In IAS 38 you will see cost of intangible may include some material cost also. Cost of intangible may include some material cost also. You might use it for R&D purpose also. So inventory allocated to another asset in this way are recognized as an expense during the useful life of that asset. So if inventory is used for property, plant and equipment item or for even intangible asset, because IAS 38 says that cost of intangible includes self-constructed intangible include material, labor and allocable overheads. Which material they are talking? This material only. What are the disclosure requirement? So one is in the financial statement. Amount of inventory that are recognized as expense. It will come in the statement of profit and loss, or what we call total comprehensive income. Then any write down and reversal of any write down of inventory. In the notes to account, what is the disclosure requirement? In the significant accounting policy section, you will disclose accounting policy relating to measurement of inventory and cost formula used. In the relevant section under notes for inventory, you will disclose carrying amount of inventory with appropriate classification. Appropriate classification would mean raw material, finished goods, raw material, spare parts, anything like that. Carrying amount of inventory that are carried at fair value less cost to sell. So biological products which are harvested. Then the commodity broker traders, they also measure inventory at fair value less cost to sell. They will follow disclosure paragraph. Measurement is not applicable to commodity broker trader, but disclosure is applicable. Circumstances that led to reversal of a write down and carrying amount of inventory that are placed as securities. These are the disclosure requirement relating to inventory. Now there is a small note from our side, judgment. This is just a discussion purpose. This standard requires a lot of judgment on the part of the management. For example, which cost formula to be used? They have to apply their judgment whether I should use FIFO or weighted average or retail price or specific identification method or standard cost method. Okay. In weighted price also, whether we should apply perpetual or periodic. So that decision you have to take. And then you have to apply judgment about the write down of inventory and reversal of write down. What are the major differences between IAS 2 and IND AS 2? So first you write in pencil there, no major difference. Copy paste version. Only one major difference that is there is discussed in IAS 1 also, that in case of IND AS 1, only nature wise classification of expense is allowed. Whereas in IAS 2, inventory can be shown as an expense either based on function wise or it can be based on nature wise. So expenses can be shown is in two ways. So if you are showing inventory as expense, then there are two choices. It can be based on nature or it can be based on function. Whereas in the IND AS 2, only nature wise classification is allowed. Okay. Now we'll solve 2-3 simple examples. Okay, ready? These examples are in self practice part. I will solve 3 questions from there and then others you will solve as homework. Come to Next, Asia Biscuit Limited has a capacity of normal capacity of 6,000 tons and the fixed annual overheads are 24,000. During the year, it manufactured only 5,500 tons. So, actual capacity is less than normal. So, for allocation of fixed overhead, normal capacity will be used at a variable cost consisting of material and labor 6 and 4. At the end of the year, 1800 tons of inventory was there. Find out the value of the inventory as per IAS 2. So, first what you should do in this problem, find cost per unit. Material cost 6 rupees, labor 4, factory overhead or fixed overhead per unit 24,000 rupees, divide by 6,000 or 5,500. Normal capacity, because normal capacity is higher. So it comes to 14 rupees per unit, cost per unit. So how many quantity in closing stock? 1800. And therefore valuation 25,000. You have to write one note. It is assumed that NRV is higher than rupees 24 per unit. You will write yourself. In all such exam answers, you will say that NRV is higher than the cost in case if you are using only cost for answering purpose. Okay, now we'll try one more. Blue Lagoon Limited produces a consumer durable whose cost of production consists of variable element of 240 per unit. The total annual production overheads are 25 lakh, out of which 40% are fixed. 25 lakh into 40%. Quickly, be ready. 10 lakh. So 10 lakh is fixed, 15 lakh is variable. The company has a normal capacity of 10 lakh per annum. It produced 20 lakh. Now in this question I have taken actual is more than normal. Actual is more than normal. So if actual is more than normal, then for allocation of fixed overhead we will take actual. Out of which 1 lakh units are still unsold at the end of the year. Find the value of closing stock. So what we'll do, first we will write rupees variable cost. Variable cost means other than overheads. Other than overheads is 240. And then we have variable overhead 15 lakh rupees, divide by how many quantity? 20 lakh. So 0.75. Then we have fixed overhead. How much? 10 lakh. Divide by 10 lakh or 20 lakh? 20. Now here you have to be careful. Actually you have to take total cost to 41.25. And what is the closing stock quantity? 1 lakh. Therefore valuation 2 crore 41 lakh. What is the note you will write? It is assumed that NRV is higher than the cost. Okay, one more I will take. Then you can solve the other questions. Cap Products Limited has an annual capacity of 40,000 units. The production overheads for the year are estimated at 3,20,000, whereas total variable cost incurred is 6,90,000. Administration and selling cost are 2 lakh and 1,80,000 respectively. At the end of the year, there were 6,000 units in stock. Find the value of the inventory given that the factory remained closed for 1 month for non-receipt of order which is a normal practice. So only problem is that should we consider this selling and administration cost of 2 lakh and 1 lakh 80,000. So this time this example is given to tell you that administration and selling cost will not form part of your inventory valuation. So what are the costs we are going to consider? First is variable overhead. Variable cost other than overhead 6 lakh 90,000. Is it right? And then production overhead. How much is production overhead? So my total cost 10 lakh 10,000. And what is the capacity they have produced? 40,000. Only one capacity is given in the problem. So we can't do anything about it. Right. So what is my CPU cost per unit? 25.25. And what is the quantity in closing stock? 6,000. So therefore, the valuation will be 1,51,500. And then you have to write a note, which I have written in the note, that inventory cost will not include administration and selling cost. Right. This answer is over. This chapter is over.